Call the meeting to order. Motion to approve the agenda. Oops.
I so move, David.
Second. Kevin, moving second. All in favor?
Aye.
Motion carried. Conflict of interest, if any. None. So we move on to the staff report on the post-closure review. First quarter. And Mary Kay, we will be as short as we can be.
Sounds good. Thank you, Mr. Chair. I'm just going to take a minute and share my screen so you can see that report. All right, so this is the investments for the first quarter of 2026. When we look at the asset allocation, you can see at the end of March, we were in compliance with our investment policy statement. We had 1.5% in cash, 21.5% in fixed income, and 76.9% in equities. So for the first quarter of 2021, we did see a decrease in the market value of our investments. I don't think that's going to come as a surprise to most people, given the world events and their impact on the market that we're seeing. I'll let Colin give his expert opinion on that. But overall, in the first quarter, excuse me, our investments were down about 96,000 or 1.37%. But it is important to note that we do have a long-term horizon for this portfolio. We have over 30 years until we estimate to need these investments. And our historical rates of return have more than adequately met where we need to be to get the fund to where it needs to be in estimated 2057. So I'll let Colin talk about what's going on with the markets, and then we'll answer any questions you might have.
Sure. Thanks, Mary Kay. Yeah, as Mary Kay mentioned, Q1, as I'm sure most of you know, has been a little bit noisy. So, really what we watched for is the conflict in the Middle East started to drive the markets a little more and wag the market's tail for that matter. What really is triggering that is the impact on energy prices. And ultimately, when we look at the quarterly reporting, we look at March 30th and 31st as the low on the year so far. I always like to just put an asterisk beside that, because even in the trailing 3 weeks to today, we've recovered all that and then some. So when we look at sort of point in time reporting, that's sometimes the artifacts we see. But with that, what's going on is markets are looking at what can this conflict in the Middle East really do in the future. And if energy prices remain elevated in a long term, that's going to really have a significant impact on the global economy for that matter. But really, most analysts and most of the opinion is that this conflict will be relatively short, and we are seeing even since the end of March some commentary around ceasefire and what that might look like. So the global estimates on growth before the conflict happened on economic growth were around 3.1%, and to give you an idea of what the expectations are, with what's going on, that revision has only gone down to 3%. So it's only 1/10 of a percentage point that the expectation is, that the expectation on impact or the impact it might have. If that changes, and the conflict extends beyond, what we're, sort of seeing in a shortened timeline, that's going to change everything, which is what causes this volatility where, day by day, week by week, markets are really trying to price that in, and that's what causes the volatility, is the uncertainty on how long the conflict could prolong, for that matter. The big thing is entering into the conflict, what we saw was really strong, or at least not booming, but a positive forecast for earnings growth. The business cycle was in a good place. So, if we do come out of this conflict in the shorter term, talking in, weeks and months maybe, and not, into half a year or longer, expectation is that, we're going to see an earnings growth in 2026 that was higher than 2025. And when we invest in the stock market, if you boil it all down to the simplest terms, we're buying, companies' earnings. And so when we're buying earnings that are, projected to grow, we think that's a positive outlook for the market as a whole. And where does that positivity come from? Why do we think the growth's up? largely comes back to, AI and efficiencies for organizations. Most companies are, looking at a more profitable year, at the cost of maybe labor costs, which, is one side of it, but certainly, positive outlook so long as we can get out of this, inflated energy crisis in the shorter term.
Any questions? Well, thank you very much for the part. Mary Kay, we'll move on to the first quarter operating results then, if there are no questions on the staff report for post-closure.
Sounds good. Thank you, Colin.
All right. Thank you. My pleasure. Take care, guys.
All right. So first quarter of 2026, looking at the balance sheet. So again, this is a point in time. So as of March 31st, we did see cash increase from the previous month. It had a balance of 3.2 million. The increase of 1.7 million was largely due to annual funding that we received from the government for economic development and community development as well. It also corresponds with why our deferred revenue is up. So we get the cash in and then we recognize that revenue as we earn it throughout the year. Our accounts receivable were up about 386,000. That has to do with borrowing that we're going to finance the purchase of our dozer through the Municipal Capital Finance Corporation. That won't be done until later on in the year, so it sits in a receivable until that debenture is issued. So overall, our current assets were up to just under 5.5 million at the end of March. On our non-current assets, they're pretty consistent. They're at 35.4 million. It is important to note, though, that ARO investment, that post-closure fund that we just talked about, we do not mark that to market value until the end of the year. So that $7.2 million that's sitting on the balance sheet is not at market value. That's at market value at the end of 2025, and then any earnings that we've received in 2026. So total assets to the end of March were 40.9 million. On the liability side, our accounts payable were up to 1.5 million. Again, the dozer was sitting in payable at the end of March. We talked about deferred revenue, that's 2.2 million, and then our accrued debt servicing was 306. So total current liabilities at the end of March were just over 4 million. Our long-term liabilities are pretty consistent. They come in at 12.8 million, and our equity of 23.9 million gets you to liabilities and equity of the 40.9 million. So if we move on to the statement of income, the first fund that we see is the Regional Planning Services Fund. For the first quarter, if we're looking at the actual year-to-date column, you can see we had a surplus of just over 61,000. That's about almost 30,000 higher than what we had budgeted. And what is driving that is savings on the admin expenses. So we had budgeted for 75,000. In quarter one, we had only spent 48,000. So we are seeing some savings on the corporate service expense allocation. That's due to some funding that we did receive that's in corporate services that's offsetting some of those expenses. And our administration expenses, we haven't spent the majority of the budget for quarter one, but that's going to be coming as we get into work in the coming quarters. For local planning services, for the first quarter, we had a surplus of 82,000. That is a little bit less than what was budgeted for the same quarter, about 8,300 less. And what you can see is driving that is we had a little bit less other planning revenue. That would be our blue plate sales. And we had expenses that were slightly over. So our operating expenses were about 30,000 higher than budgeted for the first quarter. What's driving that is some office expenses as well as some salaries and benefits. But because of the savings in corporate services expenses, it only resulted in a slight overage of about 7,000. So close to budget, but we'll continue to monitor that as we go forward during the year. Solid waste services is the next budget we'll look at. So for the first quarter, we had a surplus of 158,000. What we had budgeted for the same time period is 367,000. So it's about 208,000 less than what we had budgeted. What we're seeing in solid waste is that our tonnage is down for 2026. And it's not isolated. We did finish 2025 with less tonnage than we had expected. So what we've been budgeting for the last few years, well, for last year at least, and this year is 86,000 tons. Where we've seen us finish 2025 was about 84,500. So we're seeing a little bit of a slowdown in our garbage tonnage. And we're about 1,000 tons under budget for Q1 as to where we expected to be. That amounts to about $114,000. So that's what's driving this decrease, that where you see this unfavorable variance of 87,000. So going forward, that's going to be something that we'll have to look at for our 2027 budget and most likely adjust accordingly to make it more realistic to what we are actually receiving. Our other landfill revenue more than makes up for the unfavorable variance in landfill revenue, and that relates to the disposal of our dozer. So when we purchased our new dozer, we sold our other dozer. We received $127,500 for that, which is great. It's a timing difference because we had budgeted to have that come in later in the year. So that will go away as the year progresses. The other thing to keep in mind is we had budgeted $200,000 for that dozer. So we are going to have a shortfall when it comes to that other landfill revenue. On the expense side of things, you can see we are higher than what we had budgeted for Q1. So expenses came in at 2.5 million, which is about 236,000 over where we had expected to be. Most of that is just timing. And the operating expenses, we did some work on the baler and we had an order of wire come in, which was budgeted for later in the year. So I expect those will balance themselves up. On the capital expenses, we did have a forklift for a cost of 120,000. You may recall in 2025 when we were finalizing, we said that forklift was not going to arrive in time in 2025, so it was going to come in 2026. So that is what's resulting in part of that overage, and that's going to carry forward throughout the year. But because we were able to transfer extra money into our reserve fund last year, if we run into difficulty going forward, and we're looking like we're going to have a deficit because of this timing difference, we can always transfer less to our capital reserve for 2026. So that's available to us. So again, we're under budget for 2026 Q1, and it's something to keep an eye on because of the tonnage specifically. The other thing that I do want to bring up is our fuel, what we had budgeted for fuel. We are spending more per liter than what we had budgeted. So that's something that could affect our financials going forward if the price of diesel doesn't come down. The next fund that we'll look at is power generation. For the first quarter, we had a surplus of 173,000. That's 102,000 higher than what we had budgeted. You can see our revenue is down about 19,000 from what we had budgeted, but our expenses are also down from what we had budgeted. So that's what's resulting in the favorable variance. But that's probably a timing thing. It just depends on when the maintenance are done on the engine. So I don't expect that level of operating expense savings will be realized throughout the remainder of the year. For regional tourism promotion, we had a surplus of just under 15,000. And what's leading to that favorable variance is savings in our expenses. So our operating expenses were about 3,700 less than what we had budgeted for the quarter. And we're seeing that corporate service expense allocation. Again, that savings is carrying forward. So that's what's driving that surplus. Same story with economic development. We had a surplus of 18,668. That's about 29,000 higher than what was budgeted for the same time period. A lot of that savings is being generated by corporate service expense allocation being less than budgeted. Community development had a surplus of just under 20,000. which is about 7,800 higher than what was budgeted for the same time period. You can see our other funding is higher than budgeted, as well as our grants. So that's money that we receive from the province, and it just kind of flows out to various organizations. So that offsets each other. For regional transportation services, there's a surplus of 24,000, which is about 8,200 higher than what we had budgeted. Again, our revenues are a little bit less than what we had expected for that time period, but the expense savings more than makes up for the shortage in the revenue. For public safety, surplus for the quarter was 6,600. It's about 3,000 higher than what was budgeted. Again, expense savings is driving that. And then for sport, recreation, and cultural infrastructure, we had a surplus of just under 49,000, which is about 41,000 higher than what we had budgeted. We did receive some funding that covered some of the expenses that were incurred in a previous year. So that's what's driving that other funding of 31,000. And then our expenses are about 10,000 under budget for the quarter. So overall, we do have a consolidated surplus as of the end of March of 607,000. It's about 19,000 higher than what was budgeted for the same time period. So we're pretty close. But when you look at the individual funds, again, the one we're going to keep our eye on going forward is going to be solid waste. So any questions on that?
Any questions?
I have a question on the regional transportation. If I recall, at the end of last year, we transferred a lot of money into operating reserves in regional transportation, and we're seeing the same trend here. I think in operating expenses this year, we're underspent by 13,000. Are we at a time where we can start to give some consideration to grants to local rideshare programs and start to expand on what's being done there currently?
Maybe I'll tackle this first, and then if Brett and John want to jump in. We haven't paid out our amount to Urban Rural Rides, so that's the majority of that expense that's going to be coming out. So it's a little bit early to say if we're going to continue to have that surplus. But we didn't transfer a lot of money into the reserve last year, but the previous 3 years, we were able to build up quite a significant reserve. So when we look at the 2027 budget, we'll look at whether we can allocate some of those funds to however the committee decides that they want to determine whether they offset the budget for 2027, or I don't know what the plan would be to return funds.
Brett, do you have a comment, or John?
Well, I could add to that through you, Mr. Chair. We do have a transportation study that's ready to go to committee for review following the municipal elections. So that would be sometime, likely because of the focus on the budget in the near term when everybody gets back. We're probably thinking September, October. We'll bring that forward. To your question though, Director Fox, on allocating, that's something that we can put a staff report together and do an analysis on. There are some, as it stands right now, there are some restrictions on what we can do. From the province, that is, they really want to focus on region-wide services, but that's something that we can discuss with them, and happy to put together a report on that following the elections, and the board can discuss and give staff direction, and we're happy to follow whatever direction we receive.
I'll leave it at that.
Anyone else with questions? So, not just based on Director Fox's question, but in general, as we're going through these, I'm asking myself, is our model changing enough at this committee to keep up with the reality of the expenditure and revenue? And what I mean by that is that we're only looking at a small financial snapshot of the operation, where the other committees get a lot of the transportation committee, the economic development, tourism, they're all getting the feedback as to what's happening. So I'm wondering whether, as this goes down the road, whether we need to add KPI in here at some level, so that finance committee is getting an overview of the, not just how the money's being, whether it balances and those things, but more an idea in here, what's happening with the money. And we're shielded from that a little bit. The other, it's like the solid waste. I mean, we need to know at solid waste if increasing the tipping fee reduces tonnage, and I'm guessing that it does. I mean, it could be just diversion by circular materials. Doesn't seem they're doing that well in my community, that it would cost us a lot of tonnage, but so there are things like that that I think the finance committee going forward maybe should have a little additional view or additional reporting when the quarterly reports come up, at least, so that we have an idea of how much benefit we're getting out of the expenditure. Not that it's our business, it's the business of those committees, but just a suggestion going forward.
Well, on that, I think a lot of this is explained by timing on these, and that when we should have our most discussion is when we actually do the budgeting and the cost estimating, and I'm a firm believer that having the actual numbers is correct. So overestimating our tonnage is a problem if we're not doing that, and then because that, to make that balance, you're underestimating something else or overestimating something else to make it all work. I would prefer to have the correct numbers, and then we'll deal with the issue.
Mary Kay?
Thank you, Mr. Chair. Yeah, I just want, thank you for that comment, Director Nicklin. I agree with you that having the most accurate numbers makes for the most accurate budget. When the budget's prepared, which is like mid 2025, those were the most accurate numbers that we had. And then when we saw the decrease that happened in 2025, which was 6 months out, and now it continues to trend, we definitely have to take a step back and revise those figures.
Any other questions, comments? Fine. John, anything to add?
I guess, Mr. Chair, just on that, looking to the committee and looking to the structure, one of my intentions is, and hopefully it'll be the intention of the full board, we're at a place in our strategic plan where we've accomplished pretty much the vast majority of all of the things that we said we would do. There are some areas that are big, heavy lifts that we still need to go back and revisit. We recognize the need for better KPIs and better, now that we're a little more mature as an operation, I think that's when that discussion can happen organically and robustly amongst the directors and, and the folks that we bring in to help develop the strategic plan. And we're hoping to start that in the fall with that. So I think that's just something to keep an eye on as we move forward, and we'll work together on that. And as Mary Kay says, having the most accurate numbers to deal with is certainly the best way forward. And I think Director Nicklin was right as well. During the budget deliberations, we have a lot, we've thankfully, due to this committee and due to the recognition of the board, we've added those extra layers to the budget process. And that's where those conversations can really happen. So I think that's right. And Director Fox, just on that, Brett was absolutely right. The the contract for urban rural rides, has some limitations around that, so. We'll explore that. I know Breton, will take a peek at that. And certainly have a look at it, but there are some definite limitations that the province puts on us, especially around funding other rideshare services in terms of that. So just wanted to let you know, it's not an us problem, but we'll try to solve some of that problem and see what we can do.
Any other questions? Just on the rural transportation issue, there are other RSCs that are moving in much different directions in the province, so, and, so it's.
And
Now,
Mr.
my
Chair,
point here.
so, sorry, Mr. Chair, if I may, I had, I spent the last 3 days with the CEOs from around the province and had long conversations with them about their ride services and what they're doing differently. And Brett and I had a brief chat on that just this morning. I didn't get back till late afternoon yesterday, so so we had a chat this morning briefly on that. And I also asked some of the other RSCs if they'd be willing to share what they're doing and what that looks like. And they said 100% not a problem. So.
If I could add something to that, Mr. Chair, I'm actually in Moncton right now at a regional transportation meeting with the other RSCs. So I'm here to listen and learn whatever I can so we can present those options to the board for discussion. So we're certainly open to improving our approach to it.
Thank you. Any other questions? Motion to adjourn is in order.
Motion to adjourn, Dave Morslow.
In favor, we are out of business.
Thanks, everybody.
Thanks, everyone.
Hey, good luck to all of those that need it. I guess it's if David, you're in, or you're in, Tim?
I'm
No,
not-
you're running,
no.
Yeah, sorry.
and Tim, you're,
Tim's
you
the claim,
acclaimed, Tim?
I believe.
Yeah, I've been acclaimed, yeah.
Good.
Nobody else
And,
wanted the job.
Everybody's ready to run against you.
By the way, did I send you a note? About
Yeah.
the, good.
Yeah.
They should be working on it now, I guess.
Recorded that.
I won't say anything else here.
Oh, wait,